this is where we talk about the European economy as a whole, right? But there are other economies which are affected by this entire scenario. It is the newly upcoming or the emerging economy. So we speak about the second largest economy in terms of population. We speak about lots of spending power and purchasing power, right? So we talk about India, the face of emerging economies at the moment. India has been performing pretty well through this crisis as well. So let's have Aruna's take on the Indian economy. So Aruna will be representing the entire back office, who is the backbone support of our organization. So let's get take Aruna's take on the entire analysis of how Indian economy and other emerging economies are impacted by such a turmoil way far in the US.
Hi everyone, thank you for the introduction, Shreya. As Selena has discussed about the impact on the developed economy, which is Switzerland, very wonderfully. Now I will be discussing how the banking crisis and US debt ceiling has impacted an emerging country, which is India. So in India, majority of tech startups and IT firm sectors often rely on foreign investors, which is most likely to be affected by US banking crisis. Before we move on to the impact of banking crisis on Indian economy, we will look into the exposure level of Indian companies to foreign banks. Currently, TCS has 38.5% exposure with foreign banks, Infosys has 29.3%, LTI Mindtree has 37.4%, and Emphasis has 61.9% as on December 2022. Currently, 41% of India's revenue, which is equivalent to US dollar 245 billion, is in the IT sector, is from banking, financial, and insurance services only. So now we will look into how 2008 collapse has impacted India. India at the time of 2008 crisis was less dependent compared to the present scenario on the US economy, and hence it was less exposed to the negative side. However, it was not completely guarded. India's dependency in terms of GDP was 25%. During the 2008 crisis, the GDP growth rate was hit severely, dropping to 6.72% from 9.32%. Approximately US dollar 12 billion worth of investors withdrew from the stock markets, due to which a huge fall was witnessed in the Indian market. In India, only ICICI Bank, which is one of the largest private sector banks, was partly exposed to the crisis, but it managed because of its strong balance sheet and timely actions by the government. The timely action taken by RBI is to impose a higher provision requirement on the commercial banks lending to the real estate sector, which helped to curb the growth of real estate price bubble. The indirect impact of 2008 collapse on India's liquidity squeeze in the global market, due to which Indian banks and corporations are compelled to shift the credit demand from the external sources to the domestic banking sector. This move, this move exerted a lot of pressure on liquidity in the domestic market, and consequently short-term lending rates shot up abnormally. Moving on to the present impact on the of the banking crisis, India's dependency level can be understood by looking into the interest rate relationship between India and US. When US Fed increased the interest rate, the difference between the interest rate of two countries decreased, thus making Indian rupee less attractive. At that time, Indian rupee has depreciated by 10%, which resulted in money outflow from India to US. As per theory, if the currency depreciates, the country's exports will be very attractive and it will increase. But India's export didn't increase. Spread between US and Indian government bonds narrowed, causing global funds to pull money out of India, which resulted in huge FPI outflows. Sensex declined 290 points and traded below 58,000. Sell of banking, financial, and IT stocks has declined the overall Nifty market capitalization. Bank Nifty has witnessed a significant loss of rupees 1.33 lakh crore, which is 4% within three trading sessions from 10th March 2023 to 14th March 2023. This decline was triggered by the collapse of SVB on March 9. NSE IT was down by 2.2%. IT services in India is expected to have a growth slowdown in the financial year 2024. TCS slipped over 8%, Infosys by 6.8%, Wipro by 6.6%. According to the IT minister, Indian startups had deposits worth $1 billion in SVB. SVB had become the preferred bank for tech startups due to the flexibility, special benefits, and customized solution it offers. The SVB fallout they were raised to liquidity squeeze and challenges in raising funds which leads to thousands of job losses. Now we will move on to the impact of US debt ceiling on India. What is a debt ceiling? That is nothing but a credit limit of a country. India's debt ceiling is not explicitly expressed in terms of rupees or any other currency. Instead, it is expressed as a percentage of India's GDP, whereas the US debt ceiling is explicitly expressed in terms of dollars. Currently, US debt ceiling is US dollar 31.40 trillion, which is approximately 130% of its GDP. Current India's debt ceiling for general government is 60% of GDP and for central government is 40% of GDP for the financial year 2024 as per CAG report. Now we will look into how US debt ceiling will impact Indian economy. If the debt ceiling limit is increased, US borrowings will also increase, which leads to more interest payments. Currently, US interest payments is equivalent to defense expenditure. If this continues, US needs to cut off from some of the welfare activities, which may lead to political uncertainty in India. If US is having political instability, India's exports and imports will be affected as India exports commodities worth US 76.17 billion, which is nearly 18% of its GDP, out of which pharma alone contributes US 6.71 billion. If US plans to cut down the welfare in medicine, then pharma exports of India will be majorly affected. As I already mentioned, that debt ceiling is nothing but a credit limit of a country. When a credit limit is raised for a person, it will be seen as a positive rating for a person. But when it is raised for a country, till the optimum utilization, it will be a positive effect on the economy. Beyond that limit, it will have a negative impact. This we can understand by MM theory. This theory states that if a company's debt is increased, it will decrease the overall cost to the company till the optimum level. Beyond that level, if the company keeps on increasing its debt, the fear of not getting returns will make the equity costly, which leads to an increase in the overall cost of capital to the company. Likewise, if the debt ceiling is increased beyond the optimum limit, it will impact the investor confidence of that country. As we already saw, that US debt ceiling is approximately 130% of its GDP, which is considered beyond the optimum limit. If US debt ceiling issue is not resolved within the time frame, it will shake the investor confidence in US, which will impact the Indian stock market as it is a connected economy. Investors will feel that their interest is not safe in the stock market, so they will move towards the bond market for safety. There are chances that India might face a sell-off in the stock market. India holds a significant amount of foreign exchange reserves, including US Treasuries. A downgrade of US debt can also result in losses on these investments, potentially impacting India's foreign exchange reserves and the overall financial stability. Thank you for the opportunity.